Welcome to City Education, where we deliver education for all forms, shapes, and sizes. In today's video, we are diving into a crucial accounting and bookkeeping tool that helps businesses stay on top of their finances: bank reconciliation. Whether you're a student, bookkeeper, or just trying to understand your records, this video is for you. Let's get started. So what exactly is bank reconciliation? Well, it is the process of comparing your cash book, which is a record of all money you've received and paid out, with your bank statement, which shows what your bank has recorded. Simplified, it is the process of comparing your checkbook and your bank statement. Let's talk about why bank reconciliation is so important for any business, law firm, or even personal finance. There are 3 key reasons, and we'll explain each one with an example. Firstly, to ensure accuracy and control over cash. Now, your cash should be a true reflection of the money flowing in and out of your bank account. But what if you accidentally double record a payment in the cash book or forget to record a client deposit? For example, you enter a payment of 3,200 twice in your cash book. Your actual bank balance is correct, but your cash book shows you have 3,200 less than you really do. A reconciliation will help you spot and fix the error, giving you full control over your actual cash position. Secondly, to prevent fraud. Bank reconciliation also protects you from fraud or unauthorized transactions. By comparing your records with your bank's, you'll be able to identify suspicious activity quickly. For example, let's say your bookkeeper makes an unauthorized transfer of 5,000 Rand from your business account. If you're not reconciling regularly, you may not notice until weeks later. But monthly reconciliation would reveal unexpected debit immediately. Thirdly, to keep your financial records clean and compliant. Now, accurate records are essential for tax purposes, financial reporting, and business decision making. If your books are incorrect, everything from your budget to your compliance can fall apart. For example, imagine your accountant is preparing your tax return, but due to unrecorded bank fees and client deposits, your income appears lower and your expenses appear higher. This could lead to incorrect reporting or even a compliance issue with SARS. Reconciling ensures everything matches before you report it. So, why don't cash books and bank statements always match? There are 4 main reasons. Now let's break them down. Firstly, we have transactions that appear on the bank statement but not in the cash book. These are the entries the bank has processed, but you haven't recorded yet in your book. For example, your client deposits 1,500 Rand directly into your account, but you haven't received a payment notification or recorded it in your cash book yet. So, your bank shows more money than your cash book does. Secondly, there are transactions in the cash book that don't appear in the bank statement. These are usually entries you've recorded, but the bank hasn't processed yet. For example, you issued an EFT payment to a supplier on the last day of the month and recorded it in your cash book, but the bank only processed it 2 days later. That payment won't yet show on your bank statement. Thirdly, we have errors by the bank. Yes, banks make mistakes too. They can duplicate charges or process wrong amounts. For example, your bank charges you 500 Rand for service fees instead of the usual 50 Rand. You wouldn't know this unless you checked the statement and reconciled it with your own records. Fourthly, we have errors made in your own cash book. This includes typos, duplicated entries, or missed transactions. For example, you accidentally record a payment of 2,800 as 8,200. Now your cash book shows much more than you actually have in your account. Now let's look at what you need to reconcile. Before you start reconciling, make sure you've got all the tools. Firstly, you need the previous month's bank reconciliation statement. This helps you track whether last month's outstanding items have now cleared and whether any unresolved issues remain. For example, last month you had a deposit of 3,000 rand that hadn't reflected yet on your bank statement. This month, the deposit should appear and you'll take it off as cleared. The second thing you will need is your cash book. This shows all entries your business had recorded. Basically, your money received, the payments made, and closing balances. Thirdly, I'm sure you know what this is, but thirdly, you'll need the bank statement. This is your official record, showing money coming in, which are credits, money going out, which are debits, and the closing balance for the same period. Moving on, let's look at the different types of transactions that cause mismatches between your cash book and your bank statement. These are called reconciling items, and they usually fall into three main categories. Firstly, we have transactions in the cash book, but not yet on the bank statement. These are transactions that you've recorded, but the bank hasn't processed. For example, you recorded an EFT payment to a supplier for 1,200 Rand on the last day of the month. This would be recorded in your cash book, but because the bank only processes it the next day, it's missing from this month's statement. Example B. You've deposited 3,000 Rand into the bank after 3 hours. It won't show up until the next business day. It would be in your books, but not yet on your statement. Let's move on to the second category. These are transactions on the bank statement, but not yet in the cash book. These are transactions that the bank has already recorded, but you haven't updated in your book. For example, the bank deducted 60 Rand for service charges, but you forgot to enter it in your cash book. Example B. A client transferred 2,500 directly into your account, but you haven't received proof of payment, so it's still missing in your records. Example 3, or C in this case. A debit order for your office Wi-Fi of 450 Rand goes off, but no one recorded it in the cash book. Now, the third category constitutes of errors, which are made by the bank or the business. Sometimes errors slip in. They can come from either side. For example, let's look at a bank error. The bank processes a duplicate charge of 800 Rand. You only made one payment, but it was debited twice. That is an example of a bank error. Example 2, the business error. You meant to record 750 but accidentally typed 7,500 into your cash book. Now your books are far off. If you look closely, you'll notice that these categories are very similar and practically the same as your reasons for differences between the cash book and the bank statement. Now that you've identified the reconciling items, it's time to record them properly using a supplementary cash book. This is a temporary cash book used to update your original one with transactions that were missing. Now, step 1 of preparing this book requires you to start with the current closing balance. If your balance is positive, then you record it on the debit side. If your balance is overdrawn, then you record it on the credit side. For example, your cash book shows a closing balance of 2,500. This means your supplementary cash book will start with 2,500 on the debit side. Step 2. Add all missing bank transactions to the supplementary cash book. Now enter all the transactions from the bank statement that went in the original cash book. Here's how to record them. If interest is received, you add it on the debit side. Bank charges or interest charged, you add them on the credit side. Direct deposits and EFTs from clients are added on the debit side. Debit orders or stop orders are added on the credit side. If a client reverses a payment, you place that on the credit side. If the firm reverses a payment, you add that on the debit side. Scheduled payments are added on the debit side. Basically, anything that increases your business money or any sort of income is placed on the debit side, while anything that takes away the money from the business or firm is added on the credit side. Let's move on to step 3. Reverse and fix any practice errors. If you made an error in your cash book, for example, recording a wrong amount, you need to reverse it and then enter the correct one. For instance, you recorded a payment of 600 Rand instead of 60 Rand. You'll credit the 600 Rand and then debit the 60 Rand to fix the mistake. Now let's look at how to prepare a bank reconciliation statement. Once you've updated your supplementary cash book, it's time to prepare the actual reconciliation statement. This is where you explain why the closing balance in your cash book doesn't match the closing balance in your bank statement, and then show how they reconcile. Step 1 of doing this is to start with the closing balance on the bank statement. This is your base number. If your bank balance is a positive, meaning money is available, record it on the credit side of your reconciliation statement. If the account is overdrawn, meaning you owe money, record it on the debit side. For example, your bank statement shows a closing balance of 8,000 Rand. This is a positive balance, so you record 8,000 Rand on the credit side. Step 2. Add or subtract reconciling items. Now list all the items that explain the difference. Things that are in your checkbook, your cash book, but not yet in your bank statement, or vice versa. Add your outstanding deposits. These are payments you've received and recorded in your cash book, but the bank hasn't processed them yet. For example, you deposited 1,200 Rand after hours on the last day of the month. The bank hasn't cleared it yet, so you add it in. Point 2. Subtract post-dated EFTs or checks. These are payments you've recorded, but the bank will only process in the next month. For example, you paid a supplier 2,500 Rand on the 30th of the month, but the bank processes it on the 1st of the next month, subtracted from the bank balance. Point 3. Subtract bank errors. If the bank made a mistake, you subtract that amount until it's resolved. Now let's move on to step 3. Calculate the adjudicated bank balance. After adding and subtracting all reconciling items, your new total should match the closing balance in the updated supplementary cash book. If it does, congratulations, you've successfully reconciled. Now let's look at a couple of tips for successful reconciliation. Tip 1. Reconcile monthly without fail. Make bank reconciliation a routine. The longer you delay, the harder it becomes to track down errors or mistakes. Tip 2. Use a highlighter or digital color codes. Mark off transactions that match between your cash book and bank statement. This makes it easier to spot what's missing. Tip 3. Always keep sporting documents, whether it's receipts, EFT confirmations, or deposit slips. These help prove and trace transactions. Tip 4. Cross-check both directions. Compare your cash book to the bank statement and the bank statement to your cash book. It works both ways. Now here are some common mistakes to avoid. Mistake number 1. Ignoring small differences. Even a 1 Rand difference is a sign that something is off. Always investigate. Even the small ones can lead to big ones later. Mistake 2. Forgetting to update the cash book after reconciling. Your supplementary cash book must be merged back into the main records. don't forget this step. Your next month's books will be off again. Mistake 3. Recording before confirming. Only enter deposits or payments after they are confirmed, not just when someone says they sent them. And that brings us to the end of this lesson on bank reconciliation. Reconciliation may seem like a small task, but it plays a huge role in ensuring the financial health and credibility of your firm, business, or practice. At City Education, we believe in education for all forms, shapes, and sizes. And today, you've just added another essential skill to your toolkit. Oh, and if you found this video helpful, don't forget to like, subscribe, share, and comment. Until the next time, stay sharp, stay accurate, and keep learning.